Hello viewers, welcome to another edition of Banking and More, where we bring you the people who matter to discuss the issues that matter. Today we are in the Central Bank of the Republic of Ghana, and we are here to have a very insightful discussion with a special guest. Our guest is Philip Abredu Otu. Philip heads the research department of the Central Bank. We are here to understand how data is gathered, how that data influences the decisions the Central Bank takes, how those decisions based on the data impact the activities of the banks, and what that means to you and I. Philip, as he prefers to be called, welcome to Banking and More.
Thank you very much, Maxwell.
At the Central Bank, what is research?
For us at the Central Bank, the focus of the research that we do is geared towards providing advice to policymakers to help them in the whole decision-making process. So our research not only focuses on advising management, but we also focus on providing technical support to the bank's monetary policy committee. And the monetary policy committee, for instance, cannot take decisions without data. So data is central to what we do, and we are always hungry for data. Without data, we don't get the picture, and without the picture, we cannot make decisions. And our activities are steeped in the law. The Bank of Ghana Act, I think section 56, 1, 2, 3, 4, clearly states what we ought to be doing as far as research is concerned. It's in the Act, and we strictly go according to what is in the Act. But that Act also gives us that power to pick up data from anybody that we want to, if we feel that that data is necessary for what we want to know. And the Act gives us the power. And the Act says, if Maxwell doesn't give me the data, Maxwell is liable and it's an offense. Maxwell can be surcharged. Maxwell can be jailed for up to a period of a maximum of, I think, 2 years. That is what the law says. So in our workings, we've developed relationships as we move along. We've developed relationships with a lot of the institutions, and they give us whatever data that we want. Now, the banks are mandated to provide the central bank with returns on a monthly basis. And we have an arrangement where these returns are deposited in a portal at the Banking Supervision Department. And there's a whole process of validation that is done at the Banking Supervision Department before we get access to that data. So the Banking Supervision will go through, I think in all they give us about 12 or 15 different types of returns. 15 or more, it could be more. And they are given to Banking Supervision. The head of Banking Supervision will ensure the integrity of the data. They go through, they scan, they check for blips in the data. They call back the banks. At times the banks will have to resubmit their returns back to the Banking Supervision. And when all this process is cleared, then they send us the green light to be able to extract that data from their portal, and then we begin to use that data for analysis.
I see. Talking about the blips, when COVID first struck around March, thereabout, the central bank came out with a report that said that it expected growth to slow to about 2.5%.
Yeah.
And then later, I think around July, you said you expected growth to come to 1.5%. So between the period you saw growth at 2.5 and then the period you saw it at 1.5, which is your latest forecast on growth, what kind of data were you looking at before you decided to revise it to 1.5%, and how did data gathering impact this?
So at the time when, as a nation, we had a sense that the COVID was really in force, this was around when we had our March MPC. At the time, At the time, we only had data on the real sector up to February. And the insights as to how growth was going to evolve was still not clear to us. Normally, what we do is that we try to predict the economy's growth using our composite index of economic activity and other data that we get from the banks. We put all these things together in a nice little model that tells us where we are headed. At the time, the assumptions that we used in our projections, given what we knew about the composite index of economic activity, which has, I think, about 9 indicators. So in the composite index of economic activity, we have exports, we have things like tourist arrivals, we also have things like the firm's consumption of electricity, which to us is a proxy for output. We also have the commercial bank's credit to the private sector. We also have indicators such as container arrivals, even at the ports. And all these things put together gives us what is known as the composite index of economic activity. Over time, we've done this thing since 2002. Over time, we've been able to build a relationship between how the composite index evolves and how our final growth numbers on a quarterly basis evolves. That relationship is established, and with certainty we know where we are headed. So at the time when we only had February data, I think it was a little bit difficult. We had to revise our numbers down further when we saw how the CIEA had evolved, especially in the months of April and May. And we saw a huge decline in the CIEA, which we hadn't seen for a very long time. So by inference, we knew where the GDP was headed, and therefore we had to recalibrate and then scale back on our earlier forecast of 2.5. Another key assumption that we made when we made that forecast of 2.5 was that we anticipated that government was going to institute a total lockdown of the economy. So in our projections and in our calibrations, we said if it's a total lockdown, then this is what was likely to be the situation. But we did not get a lockdown, we got a partial lockdown. And the partial lockdown, the dynamics under a partial lockdown is different from the dynamics under a total lockdown. So that dynamics under that partial lockdown is what gave us that 2.5 growth. But when we saw what had happened in April and May, I tell you, when Statistical Service releases its numbers for the second quarter, you would obviously see that growth has gone down, and growth will go down significantly in quarter two.
Based on what you are seeing and what is happening here, is depression part of what we could see at the end of the year as a negative growth?
A depression.
Yeah.
Look, so beyond the second quarter, what we are beginning to see is some healthy bounce back. I believe the IMF even will have to recalibrate their forecast on the evolution of growth, because we are beginning to see some green shoots in our CIEA. All the indicators that came down significantly are beginning to show some signs of a pickup. In the earlier projections, we thought that the economy will go down all the way through to the third quarter and only begin to pick up in the fourth quarter. I don't think that will be the case. I think the growth outturn will be heavy. As to whether we would be seeing, you said what, depression? Negative growth. I doubt it. I doubt it. I doubt it. I mean, for us to record a negative growth for 2 quarters, I don't think that will happen. I'm not seeing that anyway.
The pickup that you are seeing, which are the areas that are witnessing the recovery?
So we are seeing that the relief measures that the central bank put into the banks are beginning to have some impact, because we are beginning to see that new credit is bouncing up slowly. Banks are beginning to extend credit. If you look at what banks have done as far as new credit is concerned for the first half year compared to the same time half year last year, you see that new credit is picking up, and that is a positive sign. We are also seeing that following the lifting of the restrictions, electricity consumption of firms have begun picking up again. So it dropped, it tanked, and it's now beginning to tick up, meaning there's some activity going on. Meaning, but because they cannot be consuming electricity just for the mere sake of it, they must be using that electricity for production.
Okay, we are still here with Mr. Philip Abrado-Otu. He's the head of research at the central bank. We are trying to understand what data means to the central bank, how they gather it, and what impact it has on the decisions they take. We are going to turn our attention to the banking sector. What kind of data do they gather from the banks? A pandemic is happening. How is that data impacting the activities of the sector? Philip, I read your July MPC report, and it touched on the banking sector as it always did. And it said that capital adequacy ratio was still moving up, even though we had a pandemic. In terms of profitability, the absolute numbers were going up, but the growth
rate had
slowed down.
Yeah.
What are the drivers of these developments?
Well, so let me give you a picture of what we see as the state of the banking sector. I think post cleanup, the banks have held up. Liquidity is ample, capital adequacy is strong, and I think the banks are solvent. And the banks are also extending credit to the private sector. What the pandemic has succeeded in doing, from the data that we see, is that we are beginning to see some rise in non-performing loans. What this means is that we are beginning to see some defaults in some sectors regarding loan repayments back to the banking system. And then we are also beginning to see that profitability, the growth in profitability is slowing down. If you look at the profitability levels, I think as at the first half year, total profitability of the sector was about 1.9 billion. Same time last year, it was around 1.6 billion. Now, in terms of the growth rates, whilst the last year growth was around 32%, thereabout, this time around, the growth, I think, has slowed down to around 16%, although it's positive. So the profitability levels are slowing down. Well, because the banks, we understand, are investing heavily in ensuring safe protocols. In the midst of the pandemic, the banks want to protect their customers. The banks are ensuring that their staff are protected. They are acquiring PPEs, and they are also putting up infrastructure to ensure that the population can leverage on these means of safe mobile payments, and all these things cost money, and that has eaten up a little bit into their profitability levels. So profit is positive, but the rate of growth of profitability in the sector has slowed down. And of course, if the pandemic should intensify and continue all through, we would see the profitability levels coming down further.
I see. One of the concerns is COVID obviously will impact NPLs. NPLs will impact profit levels, and then ultimately maybe capital.
Yeah.
And we've just come out of a recapitalization exercise that was very tonic for them. From the data you are seeing, is this something we should be looking at, maybe voluntarily asking the banks afterwards to try and build up their capital?
So I mean, I indicated that if you look at the capital adequacy ratio, the capital adequacy ratios, I think for 2019 it was around 19.3. We are seeing a capital adequacy ratio as at June of around 21.1. I personally think that the banks are still strong. Will the pandemic? I think the key critical issue is whether the pandemic will deepen as we move along, and if that happens as we move along, it will eat into their capital base, and it could trigger another set of issue that we would have to deal with along the line. But I don't see that. Yes, I don't see. Looking around, I see and I think that life is back to normal. Everybody's carrying on with his business with a mask, and I think that is a good sign. So the worst, I think, will be in half year, but I think beyond June, moving into September and the last quarter, I think some of these things should be reversed. Of course, we've seen the NPLs go up slightly. I mentioned that, and I indicated that it's because the banks are some defaults are occurring. It will impact on their profitability levels, but we expect a turnaround. The situation is not that bad to warrant the banks being asked to put up more money for capital. I don't think so. We haven't got into that stage yet.
One of your interventions, which is similar to what is actually happening in other countries from their central banks, is the bond purchase program.
The asset purchase program.
Which is meant to inject funds into the system and then get the government to fund some of its critical projects. The other concern is, since 2015, the central bank has abstained lending to the central government, and that is part of the inflation targeting mechanism and all that. So the concern is returning to it in this way with a 10 billion portfolio. It could reverse the gains that we've achieved within the period. What is the data looking like, and what should we expect?
No, you mean data in terms of?
The data in terms of the impact that you expect from this 10 billion CD bond purchase program, its impact on inflation and then monetary policy in general.
I'll be honest with you, when we did that whole calibration to look at the impact of the 10 billion on inflation, that impact was just about 0.2 additional inflation as a result of the 10 billion injection. But that is not the issue. I think the issue is that the law itself, if you look at the law itself, the law gives the finance minister, the governor, and the controller and accountant general to sit down in times of crisis like these to try to look at ways of addressing any shortfalls in revenues to ensure that the economy moves back on track. And I think that action that we took was consistent with the law. The three persons met and they decided on the financing needs. They estimated the financing needs, and the central bank made that provision. I would be worried if that is a sustained thing that is going to come along the road. But it's just a one-time event, just to try to fill that gap that had been created as a result of loss in revenue from oil. And basically that is just what we did.
Let's now discuss some thorny issue, which has to do with
which thorny issues are these?
Which has to do with credibility of central bank data, and at times concerns come up that the central bank puts up figures that later are revised and or later are found to be different from what other data churning out institutions, including the IMF and
the IMF,
churn out. So specifically, this issue of gross and net international reserves, we noticed that the IMF issued a report that its net and gross international reserves were a bit lower than what the central bank had issued. The understanding then was that the IMF decided to exclude the sovereign oil funds.
Yeah, the petroleum funds, yes.
Whereas the Bank of Ghana added them.
Yeah.
Don't you think there should be a standard way of calculating this, so that the market then understands that this is it and this is it, so that we don't have a situation where the data is?
I agree. I understand where you're coming from, but on that particular issue, this is what the IMF does. Look, the IMF is saying that for those petroleum funds, the law requires us to go to Parliament before those funds can be made available to us in times of crisis. So although we are holding those amounts in our petroleum reserve funds, the IMF discounts it because they are saying on crisis you cannot have that on day one unless a process is triggered to get parliamentary approval. They take it out. We say we can do it if there's a crisis. Can't we call Parliament, and can't we go to Parliament and get all the necessary approvals? They see it as a much more winding process. But the monies are there, they are for the nation. Let me give you a typical example. The way Nigeria does it is even more interesting. So this is what Nigeria does. When they are looking at reserves, they look at the entire public sector's reserves. So if COCOBOD is holding some reserves in foreign currency elsewhere, it's for the country, and they treat it as such as part of their reserves. If Ghana National, Nigeria National Petroleum Company, NNPC, has reserves in forex elsewhere, it's for the country. They add all those things as part of their reserves. The only difference between ours and the IMF is that we include the petroleum funds and then some encumbered assets. There are some assets that are encumbered which we include. The IMF says that for the petroleum and those incumbent assets, we are taking them out. It's their definition, and they do that because they are an international institution and they want to have a consistent way of comparing reserves across countries. And that is why they do that. And they they do that for each country. They try to look at what the law says, so that when they are discussing reserves across countries, the treatment is fair and uniform.
We've seen the government want to spend about 11.4 billion and record a deficit of 11.4% and all that.
Yeah, that's the deficit.
That's the deficit. That
is what was contained in the mid-year
budget review.
Yeah.
That should be a concern to the central bank. From where you sit, what tools are available to you to ease the impact on growth, especially in the medium term?
So the minister is saying that beyond COVID, we need to come back to a fiscal consolidation path. So there's a clear plan to return the economy back to the pre-COVID deficit levels of around 4. The law says 5%. We've gone above 5%, or we are going above 5% to around 11. But I think what we need to do is to quickly, when all this thing is over, return the economy back, put the economy back on a fiscal consolidation path, and reduce the deficit. There is also one thing about deficits. Some deficits are good. Some deficits bring about growth.
Is this one of them?
I mean, if you dig deep into the expenditures, you begin to realize that part of the deficit is because of interest expenditures on loans. For this year, this is the story that we are going to see. Expenditures on loans that have been incurred in the past. We are paying for them heavy. The debt is rising. You talked about debt is rising. So interest expenditures on external borrowings, on domestic borrowings. Because mind you, this year, because of the COVID and because of the way the fiscal finances have behaved, government has had to also borrow substantially from the domestic markets to augment its operations. So this year, the picture we are going to see interest on domestic, interest on external, and then interest on others which are COVID related. Okay. I would be worried if we were borrowing for consumption purposes. If we were borrowing for consumption purposes and all these monies are out there chasing the few goods that we have, it could spill over into inflation. This time around, the COVID has come to take center stage. And that liquidity is coming in to fill those gaps that government wouldn't have been able to execute because of the shortfall in revenues. The economy is going down, oil is going down. And the shortfall in revenues are coming from two sides. An economy that is down, for which you cannot extract taxes. And then the other side is also oil revenues that have gone down because crude oil prices went down. So it's an external sector shock that has created a hole in government's budgetary finance.
COVID and your work, is the pandemic impacting how research is done, how you gather your data?
So the data gathering effort is still as it used to be, but it is how we analyze the data that we have this time around, given the COVID. It's what everything is now COVID centered, and it's pre and post COVID. The situation is still evolving. We are still monitoring the situation. We will continue to monitor. And we'll see what happens.
Tell me, who is Philip?
Philip? This is a tough one. Philip is what you see. Philip is what you see. Beyond the human being, he's a very social animal. Really? Yeah. I don't party. I don't party. No, in these COVID days, we don't party.
Okay.
No, but I love what I do, basically. I've been in this business for quite some time. It started way back in 2002 when the Monetary Policy and Financial Stability Department was formed in the bank. So a few of us were moved to start that department, and they told us that our role at the time was to just give technical advice to the MPC. So we started out on that path, trying to gather the data for the MPC, building up initial frameworks. I quite recollect at the time we didn't even know how We were even going to forecast inflation and growth. And anytime we went out for international seminars, we were found wanting because the questions kept coming. So you come back, you sit down, you reflect, and you begin to tell yourself things will have to change the way we do it. Because you could get away with the local. But when you move outside, it's a little bit different because in the midst of other central bankers, they begin to ask you how you do things. And you must have a structured way of discussing some of these things. And I think today anybody in the research department, those who work around these things can confidently go out and speak on some of these issues, which will be very consistent with what is done elsewhere. We have the IMF people coming in all the time to look at our frameworks. They do a TA, the technical assistant reports, and they assess the progress of work here at the research department. And I'm happy with what I see.
You're happy that you are the head?
Not that I'm happy that the work is progressing in a way that I envisaged. Yeah, I'm happy that the work is progressing. And look, in all these things, I think we need human capital. The human capital is very central. And we have very good people here in the research department who are dedicated to their work, who do anything you tell them to do, and they make the work look so easy.
They are excited about what they do because they have a boss who leads them well and gets them to do what is expected of them. We've been having a very insightful discussion with Philip Aberdu-Otu. Philip is the head of research at the Bank of Ghana, and that department gathers the data, processes it, and disseminates it to the public. That data is used for critical decisions that have an impact on you and I and the general economy. We are grateful that you took time to watch. We look forward to having you in the next edition. All the best.